Good evening, ladies and gentlemen, and welcome to the FiTT Show. Financial information for today and tomorrow. I'm Bobby P. Kinzer,
And I'm Thomas Doty.
and we are the FiTT Show, helping our people get their finances in shape. How are you doing today, Thomas Doty?
Happy and blessed, my brother. How you doing?
Man, I'm highly blessed and highly favored. You know what I'm saying? I'm telling you, man, it's just as I get older with each day, I realize how older I am each day.
It's hard work,
It's,
brother.
it's
Hard
where
work.
we talk about this financial thing. This is hard work.
Bob, we used to get hurt, right? Now
Yeah,
we hurt.
yeah, we just heard.
We used to have to do stuff to get hurt. Now,
Right.
now, now we just hurt.
Man, I feel you on that, dope. But it's a lovely day. It was snowing perversely here today in
Uh,
Bowie, Maryland, coming down. I couldn't believe it. I think yesterday it was almost 80 degrees. It's
yeah.
crazy weather, man.
I live in Charlotte.
I believe that global warming stuff, man. It must
Roll
be.
for the cold.
Yeah, I know that feeling. I might be coming down there staying with you, though. I ain't gonna lie. So let's get some of our administrative stuff out the way. Please click on the like button and the heart button as many times as you can. That's how we get traction. Every click counts as one click, so you can just click away. It really helps us. And then the next thing is please put comments in the comment box because that magnifies our existence on Facebook, especially even greater. So if you have any comments or uh, opinions or some topics you'd like for us to cover, please put it in the box. And if we can during the show, we'll cover it if we feel it's applicable. But if not, we'll reach out on another show. But I promise you, we will definitely cover that. Just want to give one little disclaimer here. We are not um, financial advisors. We do not have any fiduciary responsibilities as far as being a qualified financial advisor. Just want to give that little tip there. But we are financial educators, and we're trying to give you news that you can use. So anything you have a question about that we're talking about today or any other show, you can go out there on past shows. And please share us on Facebook and subscribe to us on YouTube. Those are two platforms that we are on. So now that I got that out the way, let's get into, it's always shocking because you never know what the market is doing. And that's why we say you must have a plan. But let's get,
It's going down, baby.
and just want to mention last week's show was money advice from the experts. And we had so many good uh, advice, so many good tips that today we're going to do money advice from the experts part two because there was just so many real good ones, and we want to share them with you. Any comments you have about them, please put them in the comment box. We would definitely appreciate that. So let's get with the top of the show, though. Let's talk about the stock mode. Are you going to give us some good news, bad
Nope.
news, or ag news?
A lot of bad news.
Oh, not good.
No, we're. If you've been to the gas station, you know what's going on because of the that's, the war in Iran, which isn't a war, right? But that's neither here nor there. Uh, the oil prices have gone up. You know, one thing I found really weird, Bob. I got two Costco's near me, one in Charlotte and one in South Carolina, and the gas price difference was like 35 cents a gallon.
Between the Costco's?
The Costco's. Now it's two different states, so I don't know if state
Could be the gas tax.
only on premium. So if you're in regular, you're good at either one. But if you're on premium, you're better off at the Charlotte. I just thought that was weird. But anyway,
It is weird. It's probably the gas tax though.
yeah. But yeah, the oil situation, Iran saying they're not going to let any tankers go through that little strait close to their land, and that's creating all kind of turmoil and is expecting oil prices to continue to go up. Right now, it's up over $100. Iran saying it's going to go up over 200 bucks, and they're not letting anything through their little strait. And so we'll see what happens. And this volatility is going to continue. And as we always tell you, don't make decisions based on what's going on outside of what you're doing. So you can see the S&P. It looks like it's flat, but there's been all kind of, well, slightly flat. It's been all kind of volatility, mostly down the last couple of days. March has not been good. It actually closed below its lowest point in December. And I say that because whenever that's happened in March, another 10% decline follows. So we'll see if that holds true. That's what's happened in the past. We'll see if it continues. NASDAQ took a little bit harder. It's down almost 2%. Microsoft's down about the same. Apple's down a little bit less. NVIDIA's staying flat. And what's interesting is that a lot of people are still buying NVIDIA. People are, I don't know if it's trying to get into the tech stocks while they're down, while it's a little bit flatter. But a lot of people are still buying NVIDIA, which is interesting to me. Google's up a couple points. Pfizer's flat. And my Boston Scientific is down 4. But again, I'm not doing anything right now. I'm just going to lay low and let this thing play out. But going to be volatile for a while, so just kind of hang in there. And I mean, I bought some more Microsoft when it took its big hit, and so that's what I'm doing. So I don't know what your situation is, but if you see a bargain, and that's anytime you see a bargain in a stock price, then try to jump on it. But things gonna be crazy till this war gets settled out, and it may kick up inflation, which they're talking about stagflation now, which is they just make up all these terms. But stagflation just means that there's no growth in the economy. The market, the GDP is staying flat, and you have inflation. So things can get really crazy, and stagflation is going to create obviously job layoffs, and it just kind of snowballs, and things will get worse and worse. But don't know if that's going to happen, but hang tight. We'll see how it goes.
Yeah, but that's some of the things we want to be talking about today. Some of the money advice, some of the money tips that we, in these times we need to be thinking about. So this is no better time to talk about that than today's show. Just like to say that gold is at $5,090 an ounce, and a year ago, just to give you perspective, it was at $2,930 an ounce. So as you can see, that's a great increase, even though it was higher last week. But silver is a year ago was $33 an ounce, and it's now $84 an ounce. It went up as high as $100 an ounce at one time, the highest it's ever been. Just to give you perspective on the commodity front, and just another indicator. Crude oil, like you said, the gas was 100 at this particular hour because those move 24 hours. It's down $96, but a year ago it was at $57 a gallon. So not a gallon. Crude oil was at $57 a barrel. Excuse me, a barrel that is, as opposed to this 96. That gives you an idea, man. It's never dropped that fast.
Yeah.
The day they said. So just give you some indicators there. Let's talk about the crypto market. Let's see how that's responding. As you can see, the market is only up. No, down, excuse me, by 17 billion. That's billion, that is. About 1%. That's across the board. You'll see that with Bitcoin. It was at $70,965 a week ago. It's now down $785 to $70,180 a Bitcoin. Ethereum is down by $11. Tether, believe it or not, the stable coin, which is pegged to the dollar and assets, that's up like 1 cent per Tether coin. Binance is still in the fourth place as the last week of Ripple. Binance overtook Ripple. Ripple was at fourth place, which is smart contract. Now Ripple is staying down at the fifth spot. That's down 3%. And USDC, which is another stable coin, is in sixth place, and that's just holding steady. So as we always say, cryptocurrency is highly speculative and only be in it if you, can afford to lose money. And so a lot of people always say, who you think can afford to lose money? But no, just that's a straight philosophy with cryptocurrency. Don't be using putting any money in there, especially if you need it short term or long term. But the whole game with cryptocurrency is the long play because, like we said, you can't time the market. It's not about time in the market, it's about time in the market. And that same thing applies with cryptocurrency. So, though, let's get into today's show. Money advice from the experts, part two.
Yeah, and then it's a lot of good nuggets in this, and that's what we're going to do today. We're going to go. We got such a positive response to what we talked about last week, and there's a lot of good information that you can get from investing grades, economists, planners, other experts, and even Bob and I'll throw in a little bit every now and then. Advice about managing your money, retirement planning, family finances. And the thing is, it's very, very complicated, this whole financial journey you're on. And when any information you get is going to help you manage that is going to put you in a better spot down the road than you are today. So we're going to continue to giving some advice from the greats, and hopefully you can get something out of this.
Now, now, most people approach personal finance in a way that's seemingly most logical numbers, budgets, and limiting daily expenses. But there's another step people often miss. The key to long term financial success starts with way well before spreadsheets and numbers. It starts with your mindset. And many of our behaviors are subconsciously shaped by deeply ingrained beliefs about money that are often formed way early in our childhood. And it's not just about knowledge, it's about behavior. And understanding yourself is a key part of that. So many of the advice today will deal with how you approach dealing with money. So you can start off though.
Okay, and the first one we've touched on it before. This is from a guy who wrote a book uh, called "A Simple Path to Wealth," and there's a ton of good reading information, and strongly recommend you do get up your game on financial literacy because, again, as I said, there's a lot to know. But the comment is reframe your thinking about saving and spending. And we're such a consumer culture. I mean, you watch TV, they're always getting you to buy something. I'm amazed at the diseases that I didn't know exist that I keep seeing pharmaceutical commercials. And then I'm digressing for a minute, but Bob, you ever notice how the side effects seems like got to be worse than whatever the disease was?
Especially he always says it in a low voice. So your liver might fall out, your head might fall out.
That's for sure. But the thing with this reframing your thinking, most people think about what they can buy with money. And if you sit back for a minute and look at one of those things you can buy is financial freedom, that may help you reframe the way you think about money. And so if you say, I'm saving for retirement, that always sounds like you got to deprive yourself to do that. But if you look at it and say, I'm saving to buy something that's very valuable to me, and that's my financial freedom. That's going to give me choices. That's going to give me options. That's going to allow me to do what I want to do. If I feel like telling somebody to go jump, I can tell them to go jump without worrying about repercussions. But financial freedom, look at that as a thing and make that your driving force as opposed to just buying things.
No question, mindset is so important because a lot of people, when you say budget, first thing they think of money on a diet. Nobody likes that. So
Yeah.
it's definitely psychological, and you need to, reframe your thinking. Now, view saving as a way to buy yourself choices. And what does that mean? This particular person, David Blanchett, head retirement research for Prudential, says, I don't know when I'll retire or if I'll retire, but I won't have much input into the decision if I don't have any savings. So it's about growing that nest egg to give yourself the choices down the line, not currently, but being able to have those financial choices at your fingertips, being able to plan for financial independence. That's more than retirement because we often underestimate how much money we're going to change over time. Like what I mean, we don't know if we'll still love our job in 10 years or if we want to do something completely different. But having savings, no matter what your job is, give you options to explore possibilities. But remember, savings is about protecting your wealth. Investing is about building your wealth.
Very good, my brother.
Thank you.
The next one's focus on what you control. We've touched on this before. This one's by a guy who owns a wealth management company. And the thing here is focusing on the things that you can control because there's so many things that you can. If you look at your TV, you're going to see Venezuela, you're going to see stuff about interest rates, Iran, Ukraine, elections, payroll, all those kind of things, which you have nothing to do with. There's nothing you can do to change those. There's nothing you can do to impact those. So focus on what you can control. Look at your budget, your spending habits, your asset allocation. Look at your plan. Think about where you want to end up. And those things will become less important because one, you can't change them. But if you build this financial base, when those things happen, they won't affect you near as much. You got to be disciplined. You got to manage your own behavior. And that's going to impact how your portfolio does over the long term. Focus on what you can control.
That's very important. It's not about what you can control, it's out of your control, obviously. Do your homework. People are careful when they buy a refrigerator, aren't you? When you buy a TV, people spend hours purchasing airline tickets trying to get the best price, but they tend to put little work into purchasing stocks. With all the financial decisions, put effort in, take some time, and be careful. Me and Doe said it's not. It takes work to build wealth, and I know y'all have heard that many a times. We're going to continue to say that, but put the work in. And this was by a manager of Fidelity Magellan Fund. I love Fidelity funds, by the way, you all.
So do I.
Yeah.
It takes work to build. It takes work to maintain. It takes work to maximize. It takes work to do all those things. Okay, the next one we have is protect yourself from yourself.
Ooh.
This is from an economist and retirement security expert and also a professor. And this one is you understanding yourself and not letting emotions sabotage your portfolio. So you see a downturn, when you're near retirement or you already retired, it can scare you. It can make you very, very nervous. And that fear gives you adrenaline, which might make you want to react to that. Okay. You got to rely on your rational self to overcome that. You got to understand those things are going to happen. and that you can't react to those. And for example, if you decide you're going to rebalance your portfolio or change your plan during the year, set a date to do it. Set that date in advance and then do it on that date. And then no matter what happens, don't make any changes until that date. That's going to not let you be affected by what's going on in the market. And this particular lady says you should do it at the end of February because nothing's really going on then and it's awfully boring. And if something does happen, you pick that date. You don't let emotions guide your decisions, and in the long term, you're going to be better off.
Hey, Joe, tell me something, man.
Yes, sir.
When did you get a dog?
Oh, I don't. That's my son's visiting.
Oh, damn, he sounds like that?
I'm telling you, said, hey, Bob, he's younger than you and he'll whoop your butt, buddy. So you better watch out.
All right, Lord. Next one. Keep it simple, man. Most valuable financial lessons came from Vanguard founder Jack Bogle. Oh, and that's another one, Doug. I love some Vanguard, and I love Bogle. He passed, but oh man, he was such a wise guy. You know, he said, who taught me the virtue of keeping things simple? That's what this particular Christine Benz, who's the director of personal finance, she said, Bogle said, I've tried to take that to heart in terms of my own household financial plan, meaning keeping it simple. He said, I like to have a portfolio with very few moving parts where you can easily identify where you do and don't have risk. That's pretty interesting. And it's simple building blocks like, broad market index funds, mutual funds, and they are very inexpensive to add to your portfolio, like index funds and ETFs. The typical worker has about 12 employees in their lifetime. And then so many people are carrying, multiple accounts, they can't even keep up with them. But, you can't get away from the complexity of each of these, like 401ks and 403bs. So to the extent you can within those portfolios, be as minimalist as possible. Keep it simple. It will keep you focused on what really matters. Your asset allocation and your savings rate is the most important factors. The savings rate is how much you are saving and how much your asset allocation is diversified.
Hey, Bob, the next one is Sue Zorman, which she's on TV. She wrote a bunch of books, and I'm about 70% in line with what she says. She also says some other things that make totally no sense to me. But this one is very important, and it's save with future taxes in mind. And this one's difficult, and I must admit that I've made some financial decisions where I didn't really think about the long-term tax effect. And part of it is, we always talk about these old things that have been around for long, like, okay, your earnings are going to be lower in retirement. Well, that's not true for me. And my earnings are not lower in retirement because of what I make in the market and pensions and Social Security and all that stuff. So I was tax deferring things. And now when I do have to start withdrawing from my IRAs, I'm going to have some pretty hefty tax bills. I mean, that's not a bad problem to have, but it could have been managed better. And that's one of those things that, she said, save with future taxes in mind. I recommend if you're 40 years old, try to think about what your taxes will be at 50, 60, 70, 80. And again, I know that's an exercise everybody might not be interested in doing, but it's so important because And the other thing that makes it difficult is no one knows what the tax rates are going to be in the future. But my personal suggestion now would be if you can pay taxes and get them behind you and you can put money in a Roth, you should do that as much as you can. Because what a Roth does, it takes taxes out of the equation forever. So any money you get in a Roth, anything you earn on there, you will not have to pay taxes on. So think about your future taxes. And really, you can take it a step further and say, think about everything in the future. Look at your whole financial situations and say, okay, where am I going to be in 10 years? Where am I going to be in 20 years? Where am I going to be in 30 years? And that's going to help you keep from making decisions, because most people do not think about their financial situation in the future. And that's people who either don't have money or who didn't have money. And again, I count myself in that bunch. I wasn't really thinking about what the future is going to hold tax-wise. And there's so many, let's call them steps to that, because you got your retirement. That's a very important situation that you have to manage as far as taxes. There's when it takes your Social Security. That's another very important one. There's Medicare costs and IRMA, which the fee is based on how much you earned 2 years prior. Then there's RMDs, which is required minimum distributions, which you have to start taking at 73, even though they're raising it to 75 for the younger folks. But those are all things that play a part in maintaining wealth. Okay, you can do all the good work to build wealth, but if you don't do the important things to maintain that, you'll pay more than you need to in taxes. And you at all costs, you should try to minimize what you pay in taxes, especially if you can do it legally and if you can do it with just some foresight and thought on what your future situations is going to be like. And I think I've told you guys, I started taking my Social Security at 66. And if I had to do it over, I probably would have waited to 70. And I say that, but I probably would have waited. But knowing what I know now, I think I would make a couple of different decisions. And that's based just on my own particular situation. But you got to look at what your situation is today and what it's going to be when you hit those threshold amounts, when you decide to retire, when you decide to take Social Security, what your IRMA costs are going to be, what's going to happen with your RMDs. Those are all things you have to look at when it comes to building and maintaining wealth. And so save with future taxes in mind.
The next one is set realistic expectations. That's one of the components of the SMART grid. When it comes to planning, be specific, make it measurable, achievable, and realistic, and make sure that you have it in a time frame. Because define what success looks like in advance when you hire an advisor. Don't wait for him to tell you what you want. Think about it in advance. Now, if your definition of success is returns that beat the market, that is not something that anyone could or should be promising you. There might be bad actors out there who will promise it, because nobody can guarantee you, how that they can beat the market all the time. That's some falsehood. So watch out for people to try to make those promises.
Hold up, Bob. I'm not necessarily disagree with you, but give you another way to look at that. If you're paying someone to manage your portfolio, the choice is manage it yourself or pay someone. And let's say you typically pay someone 1%. And we're going to define the market as the S&P 500, okay, which returns about 10, 11% on average per year. Now, if that person's not going to beat the market, then in my opinion, you're better off getting an S&P index fund and not paying the 1%. Okay, so my thought with investing with an advisor is that they're going to do better than the market. Because to me, the market is the average. So you got some people doing better than average, you got some people doing below average. If I'm paying somebody, I'm expecting them to be above average. So that's how I look at it. I'm not saying it's right. I'm just saying that's how I look at it. If I'm going to pay somebody, if I'm paying somebody, I expect them to beat the market. Okay? That's just how I look at it.
But you're missing the key word in this particular statement. It says if there is a financial advisor that's going to guarantee that he could beat the market all the time.
Nobody could guarantee anything, but
Right.
I'm expecting the guy I'm paying. And I'm going to look at it. You touched on it before when you were talking about your expectations. I'm going to look at it not in a 1 year or 2 year, but if 3, 4 years down the road, if the guy I'm paying is not doing any better than the market,
Right.
Again, I think I'm better off putting my money in the S&P index fund.
Agreed. 100%. On you, brother man.
Okay, so the next one, understanding your odds. And this is, if you're reading what's going on in the world, people are starting to bet on everything. I mean, they're betting on when we were going to attack Iran. They're betting on whether a tornado is going to hit. And some people look at investing like gambling and gaming. Obviously, I don't, because I think gambling and gaming are stupid. But that's just Thomas's opinion, because your chances of winning are very, very low. And the thing that really struck me, I've been to Vegas a few times, is when you look at the extravagance and elegance and the beautiful hotels, they ain't build those losing money. The house don't lose, okay? And it's funny, people who do gamble and go to Vegas and play the numbers, what do you call it? It's not called the numbers. What's it called? Lotteries. They can always tell you when they win. Nobody ever tells you how much they lose. And I guarantee you, they're losing way more than they're winning. And that's the difference between investing and gambling. Gambling is kind of hoping you win. Investing is you own something, and the odds are with you. The long term, you're going to do well investing over time with compounding, investing in high quality companies and securities, and being diversified. That the odds are not with you when you gamble. And this is from a lady who's a chief strategist at Charles Schwab, which again, that's another firm that's very, very respectable. But again, you don't want to gamble money away. And it's there's no guarantee, again, you're going to make money investing. But history tells you over the long term, if you invest in quality companies, that has always done well over the long term. You're not betting on the come like you are with gambling.
Yeah, that is gotta understand the odds. A lot of people don't though, because like I said, investing is owning, gambling is taking a risk.
Hoping. Gambling is hoping.
Right. The difference between owning and hoping. That's a good one. That's a good one. Dope. We talk about this a lot, man. About taking risks. No risk it, no biscuit. Sometimes you're not taking risks that you actually are taking a risk. But there's also the understanding of taking too much undue risk. This particular financial advisor talks about it was really frustrating for me during the COVID period and subsequent years to see so many young investors hyper trading with high risk 0 day options, prediction markets, and the proverbial cryptocurrency. See, young people are what they call time billionaires, though. They have a long runway to compound returns. If you put aside a little money and invest it in the stock market, the average returns of 10% a year, by the time you're 70, you have $1 million. You don't even have to do anything. Just don't touch it. So young people don't realize, like I said, it's called time billionaires.
Hey, Bob,
Yeah.
just make that point. You said you don't have to touch it, but you don't have to put any more money in there. Okay, that's just the growth.
Right.
Yeah.
Right. That's right. That's mean like you don't take anything out because we showed the chart before, and it showed that over a 20-30 year period, if you just take the 10 best, you miss out on just the 10 best days, just 10 of the best days, you can lose out on your portfolio gaining anywhere between 20 and 35% just by staying out the market. So the name of the game is, me and Dote always talk about it. It's all about the long play. So it's so important, that you don't take too much undue risk, like highly speculative cryptocurrency. Using, I know some people were using cryptocurrency in their early days for their retirement fund. That is very, very, very risky, and that's when we talk about undue risks. So we covered a big list in the last 2 days. The last two shows, we talked about the money advice from these advisors. And I'd like to, Dope.
Yes, sir.
We had a question asked by a listener. And the question said, I have some home improvement items to address. The roof replacement, the doors replaced, and interior painting. I want to take out a lump sum, but I don't know. Should I take it out of my traditional IRA or out of my 401k plan?
Traditional IRA or 401k?
Right.
See, that's tough. How old are they? Are they working? Are they retired?
They retired.
Do they have other sources of income other than?
No.
Okay, so whatever they do, it has to be taxable. If you take out 401k,
yes,
that's taxable. Taking out IRA, and are they over 59? So there's no penalty, no penalty involved.
Yes, they're 69.
Okay, do they own their home?
Yes.
And see, I'm not a proponent of taking on debt, but another thing you could look at it is doing a home improvement loan.
Home equity?
Huh?
Take out a home equity loan?
Yeah, home improvement loan. Yeah, home equity loan. Yeah, you could take a HELOC, and if you use that money for improving your home, the interest is tax deductible, and that way you don't touch your savings. Now that's what I would look at, as opposed to doing a tax triggering move of taking it out of a 401k or an IRA, which would trigger some taxes.
And the interest rate on that loan now might be about, would you say 6%?
6.5%, yeah.
Which is kind of low,
Well, they ain't low as the 2s and 3s that a lot of people have.
But the other thing is you can write that interest off, like you said.
It's tax deductible, and you're leaving your money to grow. You're leaving your money somewhere to grow. That's what I would do.
No, that's a great idea though, because I missed that. I totally missed the home equity, the HELOC. I totally
That's
missed it.
the thing about talking to people, though, man. That's me and you always bounce ideas off each other. Sometimes you remind me of stuff. Sometimes I remind you of stuff.
Right.
So many people keep their little financial stuff, close to the cuff, and they don't discuss things with other people, and they end up making mistakes. And there's so much information to know that the more sources you tap, the better chance you're going to have of getting some more information. You just got to make sure you're getting it from somebody who knows what they're talking about.
So I totally missed the HELOC, but this is what I thought of. I had a scenario because I know this person, and they had 500,000 in their 401k, and they had 50,000 in the IRA. My thought was, depending on the interest rates that each one was making, let's say they both was making 15%, right? I said it would make more sense to take it out of the traditional IRA, which has the lower balance, because if you took it out of the one that has over 500,000, that 15%, leaving it in will make way more than the one if you left it in the IRA making 15%.
No.
15% on 500,000 versus 50% on 25,000.
If you take it out, how much are they taking out?
It's 25.
Yeah, don't matter where you take it out. If both of them making 15%, it's no difference.
No, it can't be. No, if I got 500,000 and I took out 25,000, that's 475,000 that 15% is compounding on, as opposed to if I had 50,000 and took out 25, that's 15% on 25. I'm gonna make less.
No, Bob. No. Trust me.
No. So help me with that. No.
Look at it like this. You have $550,000.
Yes.
Making 15%.
Yes.
If you take 25 out, you're taking 25 out. It doesn't matter which pile you take it from.
But doesn't it? But
no.
That's why you're the CPA.
Yeah, it doesn't make a difference. Look at it. You got $550,000 making 15%.
No, I said 500. Let's stick with this there.
I
took out 25.
It doesn't make a difference, Bob. It doesn't make a difference. Trust me.
15% on $450,000.
You're only talking about the 15% on what you're pulling out, and
Correct.
You're losing 15% on 25, whether you take it out of the big pile or the little pile. It's still 25,000 coming out that won't be making 15%.
Well, hold up. So you got the 25,000 out.
Yes.
Okay.
Bob, I'm telling you.
Let me just try to help me with this. Don't help me with this.
Okay.
Because I understand what you're saying. 15% out is 15% out. I got that.
Okay.
But I'm saying next month, you got that $25,000 out. It's getting ready to earn 15%, and 15% on $450,000 is $67,500.
Bob, it doesn't make a difference which pile you got. You forget about it being in two different piles. Look at it. You got $550,000. The fact that they are in two different piles makes no difference. If you pull 25 out, that's 25,000 is not going to make 15%.
Got that.
So it doesn't matter which pile you pull it out.
But hold up. Right. No, I agree. But though, one more time. I agree. That's taking 15% is 15% is 15%. I got that. Right?
Yes.
No. I'm sorry. No. You're taking out 25. I'm sorry. You're taking out 25. Right? One more time. Stick with me. Modestine said, "Wake up, Bob."
I know, because you're missing this one.
No, I'm saying,
way to do it, Bob. You can do this after the show, but put 500,000, take out 25, then take 15%. Take 50,000, and whether you take the 25 out of over here or over here, your total interest that you make is still going to be 15% on whatever's left.
Yes, and I'm saying
it's no difference which pile you take it out of. Makes no difference.
I got you. So you're saying 15% and 15%.
Yeah.
Okay. I just thought you had a bigger pile to earn on. The interest would earn on the bigger pile.
It doesn't matter. If I got $100 and you got 500,000, we both make 15%. Doesn't matter that you have more. We both make 15%. If you take 1,000 out of yours, you make 15% less.
Yeah, but I thought by having a larger amount, 15% growing on the bigger amount gives you a bigger return.
It don't 15% don't grow any faster on a big number than it does on a little number.
Point well taken. Thank you for taking me to school, Dr. Dope. So you the damn money doctor. I ain't gonna lie, man.
Hey, when you accountant, this is what you do. I deal with money all day, man.
Nolan said, I understand exactly what Mr. D is saying. I'm glad you do, Nolan. I was just trying to find a better way to make some money. Thank you very much. Got you. So, ladies and gentlemen, so the question for all of you all who are online, both on YouTube and on Facebook Live, this is the question of the day for you. And put it in the comment box, okay? Everybody's different. We're not judging nobody. If you were given $1 million right now, today, what would be the first thing you would do with it? Put it in the comment box, ladies and gentlemen.
But one caveat.
What's that?
It's tax-free. So
it's tax-free. That's a good one. That's a good one. It's tax-free. You were given $1 million. Now, there's a million things you could do, but what we're asking, what is the first thing that you would do? Put it in the comment box. We're going to wait for y'all. Do. All right, come on. So play along with us, y'all. We're trying to make this interactive. And I know y'all, and look, we're not judging you. Okay, now said invest. Noli say, I have no money. You know what I'm saying?
We just gave you $1 million. You won $1 million.
We just gave you $1 million. We just gave you $1 million, tax-free. Modestine, and now, please tell me what you would invest it in. What was the first thing you invested? You got to be a little bit more specific than invest.
Yeah, would you buy something risky? Would you buy something conservative? Would you invest in a house? Would you invest in an island?
Sheila King said she'll call an advisor. Bam. Okay. Joanne said invest. Nope. Tell us, are you gonna buy another house? Or would you put it in a mutual fund? Will you buy a mink coat? Come on, it ain't no right or wrong on this. Rodney Myers.
I think the age has a little bit to do with that one. People our age, most of us our age, we've had all the things and probably don't get much value out of buying more things.
Hey, Carl, I know you're still on this line. I see you still on it. What would you call? Would you pay for your nephew's education? Nolia says maybe buy some stocks. Oh, thank you. Now says she'll buy rental property. That's a good one. Notice, my sister's so crazy. I put it in a shoebox under my bed. You old school bug. You need to stop. Modestine said invest conservatively. Joanne said I will call my financial advisor to see my best option. Okay. Modestine, we're not letting you off the hook. What do you mean invest conservatively? Gloria, you still out there? Linda, you still out there? Rodney Madison, Carl, you still out there? Did we hear from Garnett?
What would you do, Bob?
The first thing I would do was make sure I put it in a bank and make sure I structured that $1 million is insured until I do something with it. You know what I mean? Because what people don't know, you can put $1 million in one bank and have it fully insured. If you got 250,000 for individual account, if you have a joint account with your wife, that's another 250. That's 500. And if you have 3 kids, you can put them in trust for each kid, and you still own it. That's 1.25. So that's the first thing. And then I would, I would probably pay off my house. But the first thing I would do, make sure it's insured because you got to park it someplace, right? You got to park it someplace. But that's what I do. That's what I thought you FDIC people who are on here would have said. Okay. Motor C said, never put all your eggs. Linda, my wonderful, gracious Christian sister Linda said she would tithe. That is.
So you got 900,000 left. What you gonna do with that 900,000?
You ain't off the hook, but that's a good one, Linda. I hear you. You're gonna tithe and help the church. That's a good one. Thank you, Linda. Gloria, I know you out there. Let you went back to bed, but no, this was good. Just wanted to see what everybody thought because there's no real wrong answer, because I know some of y'all wanted to say buy a mink coat or go on a trip. I've always wanted a 3/4 length mink coat. I ain't gonna lie.
Really?
Yes, I just wanted.
You would wear a mink coat.
You know why?
At your age.
But you know why?
No.
When I saw Dr. J wear that mug in 1976. Okay.
I think the age has something to do with it. Because my first thought would be I'd buy me a fancy sports car, but I've already had a fancy sports car.
Right.
And I got rid of it because it was too hard to get in and out.
But hold up, which fancy sports car would you buy though?
Well, I'd probably buy another Porsche. But I wouldn't. I wouldn't because it's okay getting in, but I need a damn crane to help me get out when it's time to get out because they sit so low to the ground. So that would be out.
Now came back and said she'd also, that's interesting. Now you invest in a small business. What type of small business? Carl, he said he'll pay for his nephew's education. And he's in high school, right? So you pay all the way through. Wow, that's cool. It's the pump in him. Wait a minute. God, what are you talking about? It's the pump in him. Hold up. What does that mean? Did you mean to put that for us? Pump. Garnett talking about because I wanted to buy 3/4 length. She said it's the super flying Bob. Okay, funny. Good joke.
Super fly look. Bob, when I was in the 8th grade, I was the same size as my brother, and he had the shaft leather pants and coat.
Oh yeah.
I went to school one day with the shaft look.
Yeah.
Yeah.
Wow.
Leather pants and leather coat. Yeah.
And hey, Doug.
Mm-hmm.
Niecy's on a roll. She said consulting business and legal services.
And she would be doing all that by herself because I ain't interested in real property and I ain't ready to do this at my age.
Hey, Doug, check this out. My shoe size was the same size as my brother's in the 6th grade. So I was wearing their bass regions to school, but I was playing tag on that, the gravel. Man, I come back there and scraped all up on it. I put them back in their shoe rack. But I was wearing like 8.5 then, and they were wearing like 8 back then. But no, thanks for participating, y'all. That was pretty fun. Like shout out to some of y'all since y'all were participating. Garnett, thank you. Gloria, is it that they're not showing the YouTube? Yeah, they are for other people. But anyway, look, Gloria, Linda, and Nolia, though, all got on at the same time today. The same exact time. What's up with y'all coordinated like the Pointer Sisters or something? That's awesome. Carl, good to see you, my man. Rodney L. Madison. Rodney must have jumped off because I know he would have put invested in those notes, the mortgage notes. Nolia, got you again. Modestine, Sheila. Hey, Sheila King, thank you for being on with us today. And now we appreciate you so much. Joanne Skinner, always a winner. And Modestine. And I think that's everybody. Yep, that's everybody. Thank y'all for tuning in. Dope. The Big Bob quote of the day. Forgive, not because they deserve it, but because peace feels better than pride.
I like that one.
Took you a little while, though.
I had to work through it.
I didn't register. I thought you like.
I'm still stuck on how you gonna get 15% out of the pile, but
because I'm putting 15 on 500,000 as opposed to 15 on 25,000.
Gonna let us down. I'm gonna be teasing you. I'm gonna be at your funeral, or if you teasing you about this.
Dope. One more last time. You see, you brought it back up. Dope. 15%. Dope. 15% on 500,000 is $75,000.
I'm gonna send you an example of why it doesn't work. You got to look at the total, my brother.
Dope.
You got to look at the total. 15% is 15%, no matter where you take it from.
No.
Yes, it is. But
dope. Wouldn't I want to make 15% on 25,000 that's left from the 50,000 one? It's only $3,750.
My brother, 15% is 15%, no matter which pile you take it from. If you take
I'm not talking about taking it from. I'm talking about what you could earn on it.
It don't
work though. I'm not talking about. I know what you're saying. Taking 50% and 15%. I got that.
I'm gonna send you an example, and I'm going to show you. I'm going to show you.
Modestine, I'm gonna come down there in goddamn Lexington, Kentucky, and get your bus. Bob, did you ride the short bus to school? Okay. Okay. All right. I'm just telling you now, Modestine. I will come down to Lexington, Kentucky. Oh, now Rodney got something to say. Don't need to put it on a whiteboard for me. So everybody got jokes. I'm the only one that sees this a different way. I'm gonna see the scenario, though.
Hey, Bob, this ain't a different way. This is wrong. This ain't different.
But you think I'm saying
you see it the wrong way.
Now I know they got jokes. Okay. Y'all. Oh, Pile on Bob Day. Okay. I can take it. Forgive. Not because they deserve it, but because peace feels better than pride. How appropriate for today's quote. See y'all. Thank y'all for participating. Great show, Dope. And don't go nowhere, Dope. Stay on. I got to ask you something. And I got to remember what I was supposed to ask you. But stay on, Dope. Don't go nowhere. Something I'm supposed to ask you. All right, y'all have a great one. We see you next week. Same bat channel, same bat place. Have a good evening, ladies and gentlemen. God bless you.